So the compounding of your wealth is going to be a lot faster if you opt for UCITS ETFs.
And this is one of the best ways to do it because, as I always say, you want to have global exposure with the majority of your core allocation.
It's my favorite or my go-to UCITS ETF.
Okay, so before I dive in, do hit the subscribe button if you want more content like this, and don't forget to give me a follow also on my socials at TimTalksMoneySG on both Instagram and TikTok.
So when it comes to investing, there tends to be a lot of content out there about individual stocks or thematic ETFs, but there is a lack of perhaps more generic content that relates to building a core portfolio of broad market ETFs, whether that's in stocks or bonds. So today I'm going to try and share with everybody 4 ETFs that I feel you can just buy and hold forever. So let's dig in. Okay, so before I get started on the ETFs, do remember that if you are investing ETFs, it's important to buy ETFs that are listed in London or on other European exchanges. That's due to the UCITS ETF being a more tax efficient structure than US listed ETFs. Remember, there is a 30% dividend withholding tax on US listed ETFs, whereas UCITS ETFs that are listed in London or other European exchanges, they have a 15% dividend withholding tax. So the compounding of your wealth is going to be a lot faster if you opt for UCITS ETFs, because mainly UCITS ETFs actually have accumulating share classes, which means you can reinvest those dividends, or they're automatically reinvested for you rather, versus actually taking the dividends at a 30% dividend withholding rate and then having to decide what to do with those dividends on your US listed ETFs.
Okay, so let's start off first with the big asset class that we all know as equities or stocks.
Now, to get exposure to equities, I like to think globally instead of being single country or opting for just an S&P 500 index ETF. So in this sense, my favorite or my go-to UCITS ETF for global equities is the Vanguard FTSE All-World UCITS ETF. Now, this is listed in London under the ticker VWRA, and this is an accumulating share class, which, as I mentioned earlier, means any dividends you receive from this ETF will be automatically reinvested for you so that you can compound your wealth faster over time. So what do we need to know about the Vanguard FTSE All-World UCITS ETF? Well, basically it tracks, as you can guess, the FTSE All-World Index. Now, this index actually has over 4,200 stocks in it, but the ETF itself involves, or has rather, 3,600 stocks. This is primarily an equities ETF that is exposed to large cap equities, as around 80% of the ETF is invested into large cap stocks. Now, do remember that most of this ETF will obviously be invested into the US, and that is something that we can't escape given the heft of the US equity market. However, it's not as bad as maybe some of these developed market ETFs where the US makes up 70% of the ETF. With the Vanguard FTSE All-World UCITS ETF, the US makes up around 63% of the ETF, with the next in line actually being Japan at just 5.8% and the UK at 3.5%. But you do effectively have 37% of the ETF invested into countries outside of the US. And one thing I do like about this ETF versus maybe the iShares MSCI All Countries World Index UCITS ETF is that this has a slight exposure to India at just over, or just under rather, 2%. But it still does give you some exposure to India as well as a decent exposure to China. Okay, let's move on to some of the more important factors of the ETF, such as the annual expense ratio. Well, this is a relatively reasonable ETF. It's not going to be as low as some of these S&P 500 index ETFs that can be as low as 0.03% per annum in terms of the total expense ratio. But the Vanguard FTSE All-World UCITS ETF has a total expense ratio of 0.19% per annum, which I feel is pretty cheap. It did actually come down. It used to be 0.22% per annum, but it's come down by 3 basis points over the past few months. So Vanguard itself is a very reputable provider of ETFs, and they're well known for giving investors the option of low-cost ETFs. And the Vanguard FTSE All-World UCITS ETF definitely falls into that bucket. Okay, so next up we have a fixed income allocation or a bond allocation, and we can get exposure to bonds
VWRA UCITS ETF, also listed in London. And what I like about this one is that it's a corporate bond ETF. It's actually the iShares Global Corporate Bond UCITS ETF. And this trades under the ticker of CRPA, and that is mainly for its accumulating share class. So why did I choose corporates? Well, basically, Western governments are hugely indebted, while corporates are still holding up pretty well. So I thought it would be interesting to give yourself a bit of corporate bond exposure. And this is one of the best ways to do it because, as I always say, you want to have global exposure with the majority of your core allocation. Okay, so what do you need to know about this UCITS ETF? Well, as the name suggests, it invests into global corporate bonds that are investment grade in nature. It does have a weighted average yield to maturity of around 4.3%. And the good thing about this is it's another low cost ETF. So the annual expense ratio is just 0.2% per annum. In terms of the actual exposure, you have holdings of around 14,100 bonds. So you're very, very well diversified in this corporate bond ETF. In terms of the geographic exposure, this is actually less than the global equities ETF. You have around 55% of the ETF exposed to US corporates, and then the rest is in the rest of the world, mainly Europe. So in terms of sector exposure, you are a little bit concentrated. Around 25% of the ETF is exposed to financials, and then you have a combined 20% that is exposed to consumer corporates. So in total, you have around 45% exposed to just financials and to consumer-oriented companies. So that is definitely something to keep in mind with this ETF. Okay, so the third ETF is the ABF Singapore Bond Index Fund, and this is listed on the Singapore Exchange under the ticker A35. Now, one of the reasons I like this ETF is that you are buying into government securities of Singapore. And we all know Singapore has an extremely strong credit rating, a robust credit rating. It has a AAA credit rating, one of only 10 countries globally to actually maintain it. So if you are to buy into any government bonds or any government entities, I would probably want it to be Singapore. And that's exactly what you get with this ETF as it tracks the iBoxx ABF Singapore Index. Now, this index is comprised of Singapore dollar bonds that are issued by the Singapore government or quasi-government entities. Now, these can be things like the HDB, Temasek, or the LTA. Now remember that this ETF is run by Amover Asset Management, which was recently rebranded from Nikko AM Asset Management, but it's the same company. It's just undergone a rebranding. The ETF has actually been listed on the Singapore Exchange since 2005. And since its inception, it's actually delivered annualized returns of just over 2.5%, which is very, very admirable. Okay, so what about its annual expense ratio? Well, it's not as cheap as the other two ETF. It has a total annual expense ratio of 0.25% per annum. However, it is a distributing bond ETF, so they make distributions to shareholders on a semi-annual basis, so that is twice a year. In terms of exposure, it's pretty much all in Singapore government bonds. You have around 83% of the ETF in Singapore government bonds, with just under 11% in HDB assets as well. And then the rest made up from a variety of other quasi-government entities. And finally, there's obviously the average yield to maturity, which is pretty low given the strength of the Singapore government and its credit rating. So the average yield to maturity as of the end of August was just under 2%. And I can imagine that currently that is probably a little bit lower. Okay, so we have an equities ETF, a corporate bond ETF, and then also a government bond ETF. So the final ETF that I would say should go into a core portfolio allocation is a gold ETF. Now, this could come under an alternatives bucket, and obviously it wouldn't make up a massive percentage of your core portfolio. But for gold, I would go for the iShares Physical Gold ETC that is listed in London. Now, it is listed under SGLN, but that is the British pound share class. So for most of us, we'll want to be purchasing the US dollar share class, and that comes under the ticker IGLN. So this is a physical gold ETF, which means it is actually backed by gold assets. And so as custodian, JP Morgan will actually store gold bullion in its London vaults for the shareholders of this iShares ETF. Now, beyond that, there's not much to understand. It is invested into gold and it tracks the gold price. In terms of its total expense ratio, it's the lowest of the four at just 0.12% per annum. So you are actually getting really good value with this ETF. As we all know, the price of gold has been hitting record highs recently. So this ETF's performance over the past year, 3 years, and 5 years are very impressive. Now, since inception, when this ETF launched in 2011, its returns have been around 6.6% annualized. So it does show you that gold does have periods where it doesn't do much or go down, but then it has periods where it can do very well. So that is one reason why we should obviously limit the amount that we allocate to gold within our portfolios. So there you have it, my 4 ETFs that you can buy and hold forever in your core portfolio. Of course, in terms of your risk appetite, you can adjust each one. You can perhaps have a 60, 30, 10 if you want, or you can have a 60, 40 and just leave out gold. So whatever your preference is, you can adjust it according to your risk appetite. My own personal preference is probably to split the bond allocation into perhaps 20% Singapore government bonds and then 15% global corporate bonds, adding another 5% for gold and having 60% in equities. That's how I balance a 60-40 or a sort of balanced portfolio. So how would you allocate your core portfolio? Let me know in the comments and don't forget to hit subscribe for more content like this.